today what we are going to do, we have picked up two MTQs. This is from question number 140 till 149. So 140, 41, 42 is another one, and 45, 46 is here. And you people have watched this IFRS 15 revenue uh, lecture. I think it is more than 1 hour. It is almost 90 minutes lecture. I have explained everything in the lecture in very much great detail. But we just want to do something very quick recap. Let me tell you that this IFRS 15, it is a new standard. It came in like 2015. Before that, there were two old, and this is called with revenue from construction with revenue from contract with customers. Previous standards were IS 18, which was called revenue just, and there was one more standard. Why I'm writing it down, I have a reason to write down. I will speak that reason. And there was one old standard called IS 11, construction contracts. So construction contracts, usually what happened that when you were providing goods and services, you were dealing it under IS 18, but sometimes there were some contracts which were long period contracts, especially construction contracts. So which construction processes took 1 year, 2 year, 3 years, and then you had to split the revenue in between. So this was an IS 11. Both of these standards, they were canceled out and they prepared one new standard, IFRS 15. Very important standard. And you should understand that revenue is the first line on your financial statements. You understand it very well that there are 5 financial statements, and the first one which you prepare is income statement. And within income statement, the first line is revenue. When we say revenue, usually what we include inside those, your economic benefits obtained by providing goods and services from core activity. So this is very important. The word here I use, core activity. Core activity means that what is your actual business, okay? What is your main business? For example, if you are a construction company and your business is to make apartments and buildings and flats, so every time when you make some apartment and you sell it, you get benefit. This is called revenue. But if you do any other activity, but for example, if you rent out some of your construction equipment for temporary basis, that is not revenue, because renting out equipment is not your core activity. You know that when a business is created, so there is a purpose of business. We write down in articles of association that what is the name of this business and what this business is going to do. So when we created the company, we said that this is ABC Construction Company and we will do construction. So construction was agreed as our main core activity. So whatever economic benefits we will receive from construction, that will go into revenue, but we might have some other sources of income as well. For example, we have some office, we give it out on rent and we receive some money, but this is not revenue. This is called other income. We have some equipment, we give it out on rent, we get some benefits, but not revenue, because renting out equipment is not your core activity. It is just like something you do otherwise. So that goes to other income. You might have some money in the bank and you earn some interest. That is not your revenue. It is your benefit, but you should show it as interest income, not into the revenue. So you should understand that the word revenue is only allocated to that economic benefit which you will get from your core activities. So first is very important you understand what is revenue. Now, we know that under IFRS 15, okay, whenever you do standards, the first thing you talk about recognition, okay? How do you recognize it? Then you do measurement. I have explained this thing in conceptual framework. So you have different elements of accounting: assets, income, expenses, liability, capital. And all of these elements of accounting, you have to treat, you have to make four, there are four dimensions. One is called recognition. Recognition means that, can I recognize it as my revenue or not? Is it my revenue or not? So you are recognizing that particular element. Like I said, that if I give out some rental equipment, is it my revenue? Answer is no. You do not recognize it as revenue. You recognize it as other income. So recognition means that when you decide what this thing is for me, is it my revenue? Is it my other income? Is it my other comprehensive income? Is it my asset? Is it my liability? What is it? Recognition. Second is measurement, how to measure it. And third was your presentation, then where to show it. Presentation means where you will show it in the financial statements. And then you have disclosures, okay? The fourth one is disclosure. Disclosure is not important for us in ACCA F7. ACCA never will ask you to give disclosure notes. They will be only focusing on these three: measurement, recognition, and presentation. And when it comes to recognition, you had five conditions, if you remember. So there were five criterias which have been given by IFRS 15. Fazil will tell me those five criterias. Yes, Fazil, what are those five recognition criterias for revenue?
Identify the contract.
Number one, identify the contract.
Identify performance obligation.
Okay.
Then determining the transaction price.
Determine the contract price, transaction price. Good.
After that, allocating
The
the price to
transaction price to the performance obligation.
yes.
Number four is that, okay, number one was identify the contract. Number two, identify the performance obligations within the contract. Number three, determine the contract price. Number four, the performance of the contract price allocation to different performance obligation. This was number four. And number five, the last one.
Recognition of the revenue.
Perfect, Fazil. Recognize the revenue as each performance obligation is met. Great. Okay, so by the way, you should be ready. If any theoretical question comes in exam, that most probably would be coming in by for explanation of these five, steps, or these five.
Yes, sir. This question came
This will
in
come.
this.
This will come because this is the fundamental of IFRS 15. Because IFRS 15, we always start with, okay, recognition. When do you recognize the revenue? So you should be there. And then you should also consider sometimes, by the way, under IAS 18 and in general, the conceptual framework, you should remember, there is one word which we say transfer of risk and rewards. Now I am going back, little bit going back to IAS 18. Although we have got a new standard IFRS 15, but a lot of concept remains the same from IAS 18, IFRS 15, many things are same. Remember, when do we consider that sale has taken place? We say that the sale has taken place or not. Now let me come back and ask you one question. I'm not sure if I have that example somewhere in my videos in F7 or not. Um, did you did you come across any example where I explained that somebody sold a car to some other party with this condition that I will buy it back after 1 year? Did I give that example? Did you came across that example?
Mm,
No?
no, sir.
Okay. So in that example, I'm going to cover you two things. Listen carefully. Okay. Do you understand what is substance over form?
Yes, sir.
What is substance over form?
It means we do not see the transaction legally, but we see what the substance, what it is about.
And substance means what?
Uh, I don't know how to define it, sir.
Economic resources,
Economic reality.
Mhm.
So
reality.
substance over form, it says that economic reality is more important than legal form. So, which means that you may, put up many transactions in different legal formats. They might have some legal implications in the court, but as for the purpose of IFRS, we do not see, we actually prefer or we give priority to the reality of the transaction and not just this legal format. And for this, I give you an example, and this example will cover your substance over form, and it will also help you understand what is revenue. Imagine that there are two persons or two parties, A and B, and A is selling his car to B. Let's suppose this is Ali. I'm Ali, A, and B is, let's suppose Yusuf is here. So Yusuf is party B. So I come to Yusuf and I say, "Hey, Yusuf, I'm selling my car and this is for $20,000." And I sold the car to Yusuf for $20,000. We made an invoice. I gave an invoice. He paid me $20,000 and I gave him car. So what do we have in our hand? There is a contract. The contract, it exists for the sale of the car. And then invoice is there for the sale of the car. And he made the payment for the sale of the car. And I gave him the car itself. So it looks like that the car has been sold. And probably you may want to book revenue for that if selling cars is your business or whatever. So apparently it looks like a sales transaction. But when you see the contract and you read the terms and conditions in detail, you find out that I have made the contract with Yusuf that I'm selling my car for $20,000. And 1 year later, after 1 year, I will buy back this car from Yusuf again. I will take back this car from Yusuf again, and I will give him $21,000. Now, that is something which will start ringing the bells. What type of sale this is, that I'm selling it for today 20,000, and after 1 year I say that I will buy it back from you for 21,000, does not make much sense, because sales do not happen like this. It does not is a normal selling transaction. When somebody sells something, they never promise to buy back. And number two, the car is today for 20,000. After 1 year, somebody is saying, I will buy back for 21,000. Why would I give you 21? In 1 year time, the car's value should logically go down. Vehicles, they lose value after time. So why I would be willing to pay 21 after 1 year? So that strikes something in your mind that no, legally, it looks like sales, but the substance of the transaction is different. The reality of the transaction might be different. So the reality of the transaction was that when I went to Yusuf, I said, Yusuf, I need 20,000 loan. And Yusuf said, no problem, I will give you 20,000 loan, but what you give as a collateral, what you give as a security, I say I can give my car as a security. So I'm giving my car as a security. And after 1 year, I say I will give you your money, 20,000, plus I might be paying you $1,000 interest, and I will take back my car. So I say, okay, you take my car as a security, give me 20,000. 1 year later, I will come, I will pay you $21,000 and I will get back my car. So this is the reality of the transaction. Now, although you might have a contract for that, you might have sales for that, but that is not a sales transaction. That actually is a loan transaction. So in your financial statements, you should be showing it as a liability. It is a loan transaction. So in my balance sheet, the car should remain there. I should not remove the car from my balance sheet. It is still my asset. I receive cash 20,000. I put it 20,000 on the debit side, and 20,000 I create the liability on the credit side of the balance sheet. So I have got a $20,000 liability. There is no revenue, there is no sales. And because I promised to pay within 1 year, so that is going to be a current liability. So this is what many times you have to pay attention to, whether it is a revenue transaction or not. So in this one example, you understand two things: substance over form. So you identify whether it is revenue or not based on substance over form. So any decisions which you are taking or making, you must be able to relate it to some, conceptual framework reference. That why do I say, if I told you this thing that I do not consider this thing as revenue, you would say why, and I say because conceptual framework says substance over form. So while taking this decision, I must give the reference that my decision is based on which logic, my decision is based on which principle, on which convention. It is based on substance over form. Okay, then one more thing which you should remember, that while taking decision that revenue you should record or not, you should also be seeing at transfer of risks and rewards. If the risks and rewards, now I tell you back, for example, um, under IS 18, the previous standard, they gave you, and actually in business law in ACCA F4, now current ACCA F4 does not have that thing. It is sale of goods in quite detail. Actually, it is in not in UK, but when you study this F4 international, in that they have something more specific to that, where sale of goods, when sale of goods take place. So business law, it talks about sale of goods, when does it take place. So these examples are in, I think, in international version, not in the UK version. uh, for example, when you deliver the goods, that is the time period when sale of, when the revenue is recorded. For example, I'll again give you a very short example. Let's suppose that I sell, I don't know, maybe some electronics, maybe I sell these projectors, okay? So Fazil is our friend. Fazil gives me a call. Fazil says, Mr. Ali, I need an Acer projector. What is the price? I say, Fazil, it is $1,000. And Fazil says, Mr. Ali, I'm coming to your office. I want to buy one projector, but I do not have enough time. Can you do me a favor that you ask someone to get one projector from the warehouse and make one invoice and put it at the reception? I will come in very quickly. I will give $1,000 and I will take my projector and go away because I will not have time to wait. So please do this favor, get the projector and the invoice ready on the reception. I will just walk in and grab it and give the money and go away. I say, fine, Fazil, thank you very much. No problem, come in, your projector will be ready. Okay, I'm coming in 1 hour, he said. Fine, so we took one projector from the warehouse, we put one invoice on the top, we leave it at the reception. For some reason, Fazil couldn't come today. He got stuck in traffic and he said, I couldn't come today. I will come in the morning and pick up. Okay. So tomorrow when Fazil comes in, we say, Fazil, your projector was here, but somehow it dropped down and it is broken. It is yours. Please take it and go. It is a broken projector. Fazil, will you accept it?
No, sir.
But you ordered the projector, we made the invoice, and the invoice is there in our accounting system. We already have input the invoice. What should we do now?
Sir, but I ordered a working projector, not a broken, right?
No, you never said give him a working projector. You said give me a projector, and I'm just by the way, there is one joke which comes to my mind. Let me stop the recording and I'll tell you this working projector thing. This was a joke, and some 30 years ago, my uncle, my mother's brother, he told me, maybe 30 years ago. So there was an auction going on. So a person said that, there is a lottery. and he said that who want to buy a horse for $1? We are going to make some lottery. So everybody will buy $1 ticket, and whoever will win, we will give him a horse. So people were like very happy that $1 for horse, let's play the lottery. So everybody bought the tickets, lottery tickets for $1, $1, $1, $1, $1. He collected the money. And then the final day was there when the lottery will be done. So many people were gathered, and they just picked up, and one person's name came in and said, who's this ticket number? Somebody said, okay, this is me. So I got the horse. Yeah, you got the horse. And the others can go. You just lost. This guy just won. He will get the horse. So other people, they just left in disappointment. And this one man, he stayed in. And then they took him to one room, and there was a dead horse lying on the floor. And they said, this is your horse. He said, but this is dead. He said, yes, but we never said that we are going an alive horse. We said we are giving a horse, and this is a horse. He said, no, you are not being fair. You cheated me. He said, okay, if we cheated you, we can return your $1 back. So whatever you paid, we give you $1. So they gave him $1 and say goodbye. The other people who left, the $1 they collected and took the money. So similarly, I said to you that I'm giving you a projector. Okay. Now, coming back to your point, whether it is a Hera, Fazil,
Yes, sir.
contract asset. What is contract asset?
Uh, a contract asset is something like after we transfer goods.
Okay, Yusuf.
So I think when a company receives goods, they must pay the delivered goods
So that is
because by the contract.
okay. Actually, not really. Okay, I tell you. Let's not waste time. I'll
Sir,
quit.
the file is stuck. You can't see the file.
Sorry.
The Excel file is stuck.
Okay, let me explain you quickly. You have done this, like I told you that previously two standards were there. So you know that what type of questions are coming. Questions they come from sale of goods. Sale of goods, when you do, it is one time, point recognize at point in time, recognize at point in time, which means that you sell some good, you sell a mobile phone, you sell a car, you sell a furniture, you give it straight away, you can recognize the time, you can recognize the revenue now. You call it point in time. You have some provision of services. Provision of services, like you give warranty, maybe there is a insurance contract or something. So these are the things which you recognize over a period of time. Recognize over a period of time. So you don't recognize straight away. As much time has passed, on monthly basis, you will calculate how much warranty. For example, if you have received 3,000, if you have received $6,000 for 1 year warranty, and only five, so it means that $500 per month. The warranty is $500 per month. Service is $500 per month. So if 4 months have passed, you can record only 2,000 from revenue, like period over time, over a period of time. And then you also have these long-term contracts, like construction contracts, which were previously under IS 11. They also recognize over, not over a period of time, but you recognize as percentage of work done. Okay. And sometimes they may give you profit, sometimes they may give you loss. We will discuss them later on. So you long-term contracts, you recognize as per how much work has been, approved work, how much work has been approved. Sometimes you do it percentage of total cost, percentage of total revenue, depending on that. Now, let me give you, now that's something very important. And if you are not very much, if you do not do some questions, you will definitely make a mistake in exam. You cannot do it. So you need to pay attention to this thing, okay? And I will also do some questions with you. So this contract asset, actually, it relates to this situation. It relates to this situation. What happens that, let's suppose that you have a contract value, which is, say, I don't know, 10 million, okay? 10 million. Contract value is in million. It is 10 million is the contract value. And work approved is, say, 40%. So it means that you can recognize revenue for 4 million and then invoiced already. Already, how much you have invoiced? You already have invoiced, say, 2.5 million. So what happens that you have a bigger contract of 10 million of making some building. It is end of the year. You have not finished the entire work. You have finished some work, and the work which you have finished, it has been estimated and approved by the client or by the third party surveyors. Usually you have who come and approve the work. So they say that 40% of the work is completed. So it means that out of 10 million, 4 million is the revenue which you can recognize. Now, on that 31st of December or 25th of December, this was approved on, let's suppose, 25th of December. And until 31st of December, your accounting department has issued invoices for 2.5 million. So you actually have a right to issue invoice for 4 million because this is approved, but you have issued invoices for only 2.5 million. So what is the balance? This 1.5 million is called contract asset, okay? Contract asset is something which you can actually invoice or you will invoice later. Do you understand this thing?
Yes, sir.
So
Yes, sir.
you have worked approved, and you have done this thing in some questions. I think in your BPP kit, question number 79 and question number 80 is about contract value, where you are calculating the work approved or whatever. So if you have approved work of 4 million and you already have invoiced the client for also 4 million. So this is not, so your contract asset will be zero. Now, what is this 2.5 million? Now you should understand this 2.5 million is actually receivable. This 2.5 million is receivable because you have issued invoice. Okay. So what you would say that my 4 million is my revenue, 2.5 million is my receivable, 1.5 million is my contract asset. I would say this is actually, it would be debit my receivable, debit my, I'm not making a double entry here, but I mean, we don't make it like this. Double entries will not be like this, but I'm just trying to explain you that how this will be balanced in your books. In the books, it will be balanced like this. There will not be any double entry like this. I'm just showing you the balance that in your income statement, revenue goes at 4 million, receivables are 2.5 million, contract asset is 1.5 million. Now, one more question. This is, I have explained it before as well, receivable and we say accrued income. Who will tell me the difference between these two? Now, these are very basic concepts of IFRS 15. I cannot move to questions without understanding these things. Who will tell me the difference between receivable and accrued income?
Sir, receivables are invoiced and accrued income is not invoiced already.
Exactly. Receivable is that, invoiced revenue. Whatever your revenue you already have invoiced, this is receivable. And uninvoiced is accrued income. Why do we have uninvoiced? I explained this also in the in your topic lecture. Can you tell me why do you have uninvoiced? Why you do not give invoice?
Uh,
Can somebody tell me? Listen, guys, these are very basic things which are in my lecture very detailed in discuss and probably in the book as well. I'm not sure in the book if they have explained it in detail or not, but in my lecture I definitely have explained. Yes, Munira, Hira. You know why it is uninvoiced? Sometimes it happens that you provide some services throughout the month. So you provide services from first until, I don't know, until the 31st. You calculate how much work I have done here, and this work will be approved by the client in the first week. So this is my, I don't know, 30th of November. So I, from 1st of November until 30th of November, I do my job. I'm providing some transportation service, or so every time my clients they call me, make one delivery from point A to point B, from point B to point C. Every time when the client calls me on daily basis, I send my vehicles, I deliver the goods, and I make a delivery note, a dispatch note. So during 1 month I might have, I might collect 100 dispatch notes, 100 jobs done, 100 deliveries done, and on until 30th of November I collect all of them. Then in this period I send these details to client. I send to client, I say, listen, your month of November, these are the deliveries which I have made, please approve them, please check them. Once you approve it, then I will invoice you, because if I give you invoice tomorrow, maybe there will be some dispute. So here invoice I sent, I send it on one Excel file or something, and I need a confirmation from client. Okay, so client will confirm here. Client will say, okay, give this thing to me. I will check it on my end. I will tell you in 3 days. So on 5th of December, the client says, okay, this work is okay. I have checked it. You have made this 100 deliveries. I agree with it. Please issue the invoice. And then on 6th of December, I issue my invoice here. I cannot issue on 30th of November because 30th of November, maybe some delivery notes are coming at 5 p.m. in the evening, because on 30th of November I'm working, and on 30th of November the client has orders. So 30th November my machines, my vehicles, my buses or whatever trucks are working for the client. So on 1st of December or 2nd of December, my internal transportation department will collect all of them and send to the accounting department. They cannot send it on 30th because on 30th they still are working. So the month finishes on 30th. Here on 1st or 2nd or 3rd of December, I call my transportation manager, please send me the delivery notes. The delivery notes come in, I put them in Excel, I check it myself internally, and then I send it to the client. The client checks it in 2 days and gives me approval on 5th of December. And then I issue the invoice on 6th of December. But I must record something here. On 30th of November, we must be having something to show as our revenue, because this is end of the month. I have to show all the revenues and expenses of this month in here, because I have been paying for the fuel. I have to pay the salaries for November. So I must show the revenue here. So on 30th of November, my double entry is debit. I will accrue revenue. I will make one estimate myself, unapproved. This is not, client has not approved it, but we have calculated it. We know that there are 100 deliveries. Each delivery is for 65 or $60. So I will record $6,000 as my this one, and I would say credit revenue. Client does not see it. Client has no information about that. This is only in my books. Okay. Here I have not issued any invoice to the client. This is my books. I'm just putting it for myself because on 30th of November, I must show some revenue. If I do not show revenue, my month will be in loss. I will be making loss because I have made expenditures here. And then when it comes 6th of December, when I'm actually issuing the invoice, I would say debit receivable and credit accrued income. So this accrued income will be removed from my books here, 6,000 and 6,000. So you see that this accrued income was debit, now it is credit. Accrued income is gone, now it becomes receivable. So receivable is something which has already been invoiced. Understand? So receivable is the amount which is agreed between me and my client, and for which I have given the invoice, and for which the client has agreed the invoice. By the way, here one more revenue recognition thing you should remember. Revenue recognition, very important thing, criteria. Very important, it came from here in my mind. One thing with revenue recognition criteria, one more is that the client has capacity and intention to pay. You can only recognize the revenue when the client has capacity and intention to pay. So this is the client has intention to pay. The client has said, okay, no problem, whatever. Remember, in some questions, sometime, I don't think that they will do it in F7 level. But you should always remember, if any particular situation comes in where the question says that, the client is in difficult situation and it might be possible that he may not be able to give the money or he may not be able to pay, you cannot recognize. It is recognition criteria. Because if I know, listen, fair presentation. If I know that I have an invoice of $20,000 to client X or client ABC, and then I know that this client is not in a position to pay, this invoice will not be paid. When I'm issuing the invoice, end of the year, I know that this money will not come in. Then why do you issue the invoice? If you put it in revenue, if you knew that the client cannot pay, he does not either have capacity to pay or he does not have intention to pay, it means that this money may not be coming to you. So if you put it into your revenue and then you put it in your receivable on the balance sheet, you put it in revenue in your P&L, and you put it in as receivable on your SOFP, you are actually misleading the shareholders. You are actually misleading the readers of the financial statements, because you are telling them that this is a revenue 20,000 and this is 20,000 I have to receive from ABC. Whereas deep in your heart, you know that ABC is not going to pay. So if you come and tell me that we have a receivable of 20,000 from ABC, whereas you know that ABC does not have capacity to pay and it is not possible that ABC will pay. So then why do you tell me that we have receivable? You are, doing a misstatement with me. So this is very important criteria for revenue recognition, that the client should have the capacity to pay and intention to pay at the time of invoice. Are we clear?
Yes, sir. Sir, I'm having a question.
Yes, please.
Sir, if the client is having capacity and intention to pay, then we can do the accrued income thing, can we? Or
No, accrued income, yeah, of course. Accrued
okay.
income will also depend on my capacity and this thing. If the client does not have capacity to pay or intention to pay, I will not do this first one also.
Mhm.
Because if I have a doubt, or if it is probable, highly probable that client may not pay, why should I call it my revenue, or why should I call it my accrued revenue, or receivable? I should not be saying it. Otherwise my shareholders will kill me, because if I tell them that I have to receive 20,000 from ABC, after 1 week they will say, go and bring 20,000. I see, how do you bring this 20,000? I say, you know what, I knew that he would not pay. So they will say, okay, if you knew that they would not pay, then why did you tell us that we will have to receive? Do you understand my point?
Yes.
You always, I mean, in financial reporting, you always should think like that you are reporting to someone and you should be telling someone something which is true, which is fair. You should not make any misstatements. I mean, all of the conceptual framework and IFRS is based on common sense and logic. If you are my accountant or my finance manager and you come and say, okay, this is the goods which we sold, this is my receivable, and I will bring, and this money will come in January. And when January comes in, you say, you know, this client is not giving money. I said, when did you find out? He said, you know, I knew it in December. Okay, so if you knew it in December, then why did you not tell me in December? In December, you told me that this 20,000 will come from ABC, whereas you knew it in December that it will not come. So if you knew that it will not come, why did you put it in receivable on the balance sheet? This is a misstatement. This is something which IFRS 9 is going to kill for financial assets because receivable is a financial asset. This is one of the big things in many companies, whether there are financial, non-financial institutes, the banks and others, receivables everybody had. They have a lot of dead receivables where they know that the client is not going to pay. The receivables are lying in their books for last 2 years, 3 years, 4 years, and they are not removing. So they are actually making misstatement to their shareholders. Oh, we've got 10 millions in receivables. Out of this 10 million, 2 million is dead. They know that client is not going to pay. Remove it. You can't tell them that we have 10 million in receivables when you knew that this money is not going to come. Remove it. Anyways, that is enough for some type of, you know, covering up of IFRS 15. You already have your main lecture. Today's discussion, I did not teach you IFRS 15. I just teach you some points from IFRS 15. So you should watch the main lecture and this as a complementary thing, okay, supplementary thing. And now we have to move to our this questions which are bridge north. I will just create some space for that so that we have some space to do. Okay. Um, let's